Here's something most people never think about. You find a fund that pays 13%. You buy it. The check shows up every month. Feels great. But a year later, you look at your cost basis. It dropped because that fund wasn't really paying you income. It was giving you your own money back and calling it yield. That happens more than you'd think. Today, I'm ranking the 10 best income funds for retirement in 2026. Together, they yield 11.5%. But the reason they work has nothing to do with that number. It's how the income is built. 3 different engines, 3 different tax treatments, and one combination that most people never put together. By the end of this video, you'll know every fund, you'll know which engine each one runs on, and you'll know the tax move that could save you thousands every year. Here's the part almost nobody on YouTube explains. These 10 funds don't all make money the same way, and how they make money changes how much you actually keep. That one detail is the difference between a portfolio that looks good and one that pays you well. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let me show you the 3 engines and which one is under the most pressure right now. 3 engines, 1 paycheck. Before I rank anything, you need to see the blueprint. Most people look at income funds one at a time. They compare yields like they're comparing prices at the grocery store. Higher is better, right? Not even close. These 10 funds run on 3 completely different engines. Engine 1 is option premium. These are covered call funds. They sell options contracts on big indexes like the NASDAQ 100 or the S&P 500. When the market bounces around, that volatility turns into cash. It shows up as monthly income in your account. 4 of my 10 funds run on this engine. Engine 2 is private credit. These are BDCs, business development companies. They lend money to mid-sized businesses at floating interest rates. When the Fed keeps rates high, like right now, that interest income stays elevated. 2 of my 10 funds run on this engine. Engine 3 is what I call global diversifiers. International stocks, preferred stocks, convertible bonds, gold. These are the funds that go where most American investors don't. 4 run here. Each engine responds differently to interest rates. Each one behaves differently in a crash, and each one gets taxed differently by the IRS. That's what makes combining all 3 powerful. When one engine slows down, another one speeds up. Here's the myth. A 13% yield is always better than a 6% yield. Here's the truth. After taxes, the 6% fund can actually put more cash in your pocket. I'll show you exactly how later. Now let me rank the funds inside each engine, starting with the 4 that turn market chaos into monthly income. The option premium funds. The first fund is QQQI. It's from NEOS. It sells covered calls on the NASDAQ 100 index. Right now, it yields about 14%. That's the highest yield in the entire portfolio. But here's what most people miss. About 98% of its recent distributions were classified as return of capital. That sounds scary, like the fund is just handing you your money back. But it's not what you think. Return of capital from covered call funds isn't the same as a fund losing value and paying you from the losses. These funds use something called Section 1256 options. The IRS treats them differently, and when combined with active tax loss harvesting, the result is distributions that legally get classified as return of capital. What that means for you is simple. You don't pay tax on that money in the year you receive it. Instead, it reduces your cost basis. If you bought QQQI at $55 and receive $7 in return of capital, your cost basis drops to $48. You only owe tax if you sell, and if you never sell, your heirs get a stepped-up basis. The tax just disappears. For retirees focused on income, not selling, that's powerful. Here's something else almost nobody mentions. QQQI and JEPQ are 97% correlated. Owning both adds almost zero diversification, and QQQI charges nearly double the fee. Smart portfolio builders pick one, not both. Fund 2 is GPIX from Goldman Sachs. It yields about 8.7% on the S&P 500. It captures 91.8% of the market's upside while generating income. That's the best balance of growth plus income in this entire group. Fund 3 is QDVO from Amplify. It yields about 10.3%. What makes QDVO different is that it only sells covered calls when premiums are rich, not on a fixed schedule. That tactical approach means it keeps more upside when the market runs. Fund 4 is NIHI, also from NEOS. It yields about 13%. Same covered call playbook as QQQI, but on international stocks. The catch? It launched in September 2025. No bear market track record. High potential, unproven durability. 4 funds, 4 different approaches to the same idea. Every one of them sends you a check every single month. Those 4 handle the option premium engine, but there's a second engine that works completely differently, and right now, Wall Street is terrified of it. Engine 2, the private credit funds. In early 2026, something rattled the financial world. 5 of 6 major non-traded BDC vehicles froze investor redemptions. They gated roughly $10 billion in withdrawal requests. Headlines screamed private credit crisis. But here's what the headlines missed. Those were non-traded BDCs, public funds with lockups and restrictions. Publicly traded BDCs like ARCC never gated. You could sell any day the market was open. That liquidity difference is the whole story. ARCC is Heirs Capital, the largest publicly traded BDC. It yields about 10.6%. And here's the number that matters most. ARCC has maintained or increased its regular dividend for 67 consecutive quarters. Think about that. Through the 2008 financial crisis, through COVID, through the 2022 rate hike crash, through the 2025 tariff sell-off, 67 straight quarters. Its loans are floating rate. When the Fed holds rates higher for longer, like right now at 3.50 to 3.75%, ARCC's interest income stays elevated. Higher rates are actually good for this fund. Fund 6 is PBDC from Putnam. It's an actively managed basket of 24 BDCs in one ticker. It yields about 9.4%. Since inception, PBDC has outperformed the passive BIZD index by a wide margin, roughly 22.67% cumulative versus 7.89%. But I'll be honest, in the most recent year, PBDC returned just 0.13%, barely positive. The active edge is real, but it's narrowing in a stressed credit environment. Watch this one closely. Think about someone like Helen from Cincinnati. She's 66. She heard private credit crisis on the news and almost panic sold her ARCC shares. Her neighbor told her to get out before it was too late. But Helen didn't react to headlines. She looked at the data. She held. And this quarter, she collected her 67th straight dividend payment. That's the difference between reading headlines and reading the data. Before I show you the third engine, drop a comment right now. Do you hold any BDCs in your portfolio? And if so, which ones? I read every single comment and I'm curious what you're seeing. 2 engines down. The third one is the one most American investors skip entirely, and this year it's been the best performer of all 10 funds. Engine 3. The global diversifiers. Here's something that will surprise most people. The fund with the lowest yield in my entire portfolio, just 6%, delivered roughly 36% total return over the past year. That fund is IDVO. It holds international dividend-paying stocks. It's actively managed with less than 100 holdings. Here's what happened. The US dollar weakened. International stocks caught a tailwind from the value to growth rotation, and IDVO, the quiet one, the boring one, crushed everything else in the portfolio on total return. This is why yield alone is the wrong scoreboard. Fund 8 is a preferred stock fund. Preferred stocks define their payouts years in advance. That consistency is built into the contract. The fund yields about 7.2%. And here's the part retirees love. Roughly 98 to 99% of its distributions are classified as qualified dividend income. That means they're taxed at the lower long-term capital gains rate. For retirees in the 12% or 22% bracket, this is one of the most tax-efficient income sources you can own. The catch? This fund uses about 30% leverage. In a world where rates stay higher for longer, leverage works against you. This is the fund most likely to feel pressure if the Fed raises rates again. Fund 9 is KGLD from Curve. not Crane shares. That's a common mix-up. KGLD converts gold's price volatility into monthly income using short-dated options. Here's the counterintuitive part. When gold drops, implied volatility spikes, and KGLD's distributions actually increase. The payout jumped from 30 cents to 45 cents per month during gold's recent 25% pullback. More chaos, more income. But when gold rallies smoothly, distributions will fall. You have to understand that trade-off before you buy it. Fund 10 is ACV. It's a convertible bond fund that terminates around May 2030. That built-in end date creates an NAV convergence catalyst, meaning the discount to book value should close as the termination date approaches. It's trading at roughly a 3.7% discount now and yields about 7.8%. The expense ratio is the highest in the portfolio at 3.63%, and its income is funded by realized gains, not net investment income. This is a specialist tool, not a core holding. Now you know all 10 funds and the 3 engines that power them, but there's one more piece, the part that could cost you thousands every year if you get it wrong, and almost nobody talks about it. The portfolio math and the tax move nobody mentions. Let's put it all together. Each fund sits at roughly 4 to 5% of the portfolio. Some yield 14%, some yield 6%. When you blend them together, the weighted average comes out to approximately 11.5%. On a $500,000 portfolio, that's roughly $57,500 per year, almost $4,800 per month, without selling a single share. But here's where most people leave money on the table. Social Security taxation thresholds were set in 1983 and 1993. They were never adjusted for inflation. If your provisional income goes above $44,000 on a joint return, up to 85% of your Social Security becomes taxable. And here's the part that stings. Each extra dollar of dividend income can make 50 to 85 cents of your Social Security taxable too. Your effective tax rate can spike above 40%, even if you're in the 12% bracket. That's the tax torpedo. And a double-digit yield portfolio in the wrong account can trigger it. There's also IRMAA. That's the Medicare surcharge. In 2026, standard Part B costs are $202.90 per month. But if your income crosses $109,000 as a single filer or $218,000 married filing jointly, premiums jump. $1 over the line triggers the full surcharge. So here's the move that smart retirees make. They don't just pick the right funds. They put each fund in the right account. BDC income from ARCC and PBDC is mostly ordinary income, taxed at your highest rate. Those belong in your IRA or Roth. Return of capital funds like QQQI, NIHI, and KGLD don't count toward your modified adjusted gross income when distributions are classified as ROC. Those belong in your taxable brokerage. The ROC shield actually protects you from IRMAA surcharges and the Social Security tax torpedo. Qualified dividend funds like the Preferred Stock Fund and IDVO are already tax efficient. They work well in taxable accounts too. 3 engines, 3 account types. Same funds, same yield, but potentially thousands of dollars less in taxes and Medicare surcharges every year. Think about 2 people with the same 10 funds and the same 11.5% blended yield. One puts everything in a single taxable brokerage account, the other places each engine in the right account. The second person could keep $2,000 to $4,000 more per year. Same portfolio, different result. That's the whole game. Yield gets you in the door. Understanding keeps you paid. If someone you know is building a retirement income portfolio, share this video with them right now. The tax section alone could save them real money.